Hi everyone. We'll just give maybe a moment or two for people to join. There's a few people still joining. Thanks. Okay, we've got a good few joining now, so we might just kick off. We've got a moment's introduction, so that'll give any stragglers time to get in. Look, just want to say good afternoon to everyone. My name is Rob Meaney. I work with Mercer as an investment consultant. I am a member of the Finance and Investment Committee who are hosting this event. I'm also a member of a relatively newly formed group, the Sustainability and Climate Change Group. And I know they'll have a keen interest in this area as well as the Finance and Investment Committee. So, look, thanks everyone for joining today, and also to those from CFA Ireland. I know there's been good interest from both ourselves and CFA in this area generally. Just a few housekeeping items. The webinar is being recorded, and I think it's going to be posted online to active view after the event. There will be Q&A kind of throughout, really, a few opportunities to chip in with questions. So obviously they'll be recorded as well. You can submit the questions through the online portal, and that'll either appear at the bottom of the screen, so you can submit them anonymously if you don't want your name to appear beside it. And you can also use the raise hand feature as well if you want to be unmuted and ask a question directly as well. So. For society members, once you've registered, I think you're with your full name, that'll be CPD verifiable, I think, as well for those purposes. I'm just going to introduce Greencoat and the presenters briefly. So Greencoat is one of the largest renewable investments infrastructure managers in Europe, over 8 billion under management. They started life in 2009, operating as a private equity strategy on behalf of ESB, and they've evolved into an infrastructure-only manager. And it's one of the top 3 managers of solar and wind in the UK, and owns around, from an Irish perspective, around 15% of the wind market. They do operate in not just the unlisted, but also the listed space, and they have a variety of different fund structures within both. And I think you may have seen mention of them, in the papers recently in terms of some of their new investments within Ireland, Finland, and the US. The 2 presenters today are Paul O'Donnell, who is a partner at Greencoat, and actually was one of the founding members back in 2009. Paul is based in Dublin and heads there, or co-head as a co-head of their listed infrastructure business within Europe, and actually started his career at PwC Ireland here in Dublin. And Jamie Milne joined Greencoat in 2017 and is the head of investor relations for the private markets business. He lives in Gorey and splits his time between Dublin and pre-COVID in London often as well. So, and Jamie joined Greencoat from BlackRock in London. So now I will hand over to Jamie and Paul.
Rob, thanks very much. Welcome everyone to this webinar. We'll try and hopefully this will be an insightful session, and we'd welcome questions at stages throughout, as Rob said. Thank you very much to FSAI, and welcome to the CFA Institute guys as well, and any from Kaya. I'd just like to start off by doing a bit of a straw poll, if I may, and we'll try and do this using the miracles of Zoom. And if you could raise your hand to each of these questions, we'll do a quick straw poll and then we'll get going. I'd be interested to know, of the 86 attendees or so, how many of you have invested, managed, and or advised a commitment to an infrastructure fund? And I'll just give you 5 or so seconds just to raise hands across the piece there. It's always surprising when the numbers go back down again, people questioning whether they've advised or invested in them. Brilliant. So 15 or so, great. And just if you lower your hands, please. And next question is those who have been involved with, again, invested, managed, and or advised on a renewables co-investment or a commitment for fund. Good, so strong numbers there, 13 out of the 85. And finally, if you just lower your hands again, please. Final question is, in renewable infrastructure space, where do you feel the returns lie? Do you believe that renewables should deliver outsized returns in the core plus space? So I'm talking low doubles, teen type returns. Okay, so about 50% of the people, I think, who invested there. Okay, if you could lower your hands again, that's really helpful. Thank you very much. So as Rob mentioned, I look after investor relations for our private markets business and deal with all the fundraising and client service. You can see here on the front slide here some of the stuff we do. We invest across the market in bioenergy, offshore wind, solar, onshore, and on the right-hand side, it looks like it's something dodgy, but it's actually a renewable heat investment growing tomatoes. So we're in the slightly fading into the agriculture space. Apologies. Rob gave a really good overview of Greencoat. You can see some of the highlights there. We think we're one of the biggest in Europe at the moment, and Paul will talk a little bit more about Ireland. I think the key bits to pick out are that the energy that we generate across our platform actually could power just shy of 100,000 of the homes in Ireland. So across our platform, we could power Ireland on a daily basis. We think we're fairly substantial in the renewable space, and in fact, in the UK and Ireland, we are probably the top three player in wind and solar. Key point to pick out is we're based out of London and Dublin, and the team that Paul co-heads there's about 8 of us here in Dublin. I flick back and forth. Paul, a little bit on the Irish business. You're on mute, Paul.
Pardon me. Good afternoon, everybody. Paul O'Donnell. So yeah, I've been investing in the renewable energy space since 2006. I joined Greencoat in 2009, and I moved back to Dublin in 2013, which was really the time that we could see that renewable energy infrastructure as an asset class was emerging. And it was the first time that you had seen long-term pension funds started to invest into the sector and look to hold the assets for their full operational life. At the time, we could see Ireland as a very attractive market, that was going to grow substantially from a renewable energy perspective, and in particular, that growth was going to come through wind and onshore wind, as we have clearly a strong natural resource here in Ireland, and that has been the predominant technology that we've seen adopted. And I'll talk a little bit about the Irish market and how we see that evolving in coming slides. But just to give a bit of perspective, you see all the various green dots are wind farms that Greencoat currently owns and will operate for the life of their operations, so for 30 years. And today that represents about 5 to 6% of the Irish electricity market when you include all of the thermal generation, so the coal and the gas, etc. And then in the renewable sector, we are about 14% of the market. So we've built up probably the leading sort of independent or infrastructure owned space, aside from the next biggest players would be people like the utilities such as ESB and SSE and people like that. We've created a business that is highly cash generative. We'll talk to you a little bit about the economics of wind and how they work and how the cash flows operate. So we today have about 66 million of net cash in our business, but I think it'll be helpful for you to put some context around how those returns play through for investors. And then obviously speaking, we're generating a portfolio that has carbon-free electricity, and so for the last year we saved 561,000 tons of CO2. So that gives a little bit of perspective of where Greencoat is in Ireland. What I hope to talk to you about as we go through this is A, how the economics work for wind, and B, a little bit about where the growth is coming in this market. So where do we see the different opportunity sets emerging, not just in Ireland, but over right across the overall European market as a whole. So I'll pass back to Jamie, who can maybe set the scene a bit in terms of where we are from a climate change perspective.
Thanks, Paul. So just a couple of slides on climate as we stand at the moment. So on the left-hand chart there, what you can see, barring the yellow, is the carbon emissions throughout time since 1751 when the stats really started. This is and up in the top little slice, the yellow slice there, that's how much we have left to go. And if I just take you onto the right-hand side of slide 7, then you'll see a number of bars there. To keep temperatures below 1 degree, we have about 15 years or 4 years, depending on whether you have the mid case, high case, low case. And to keep below 3 degrees, we have about 75 years to not only stop the amount of carbon emissions we have at the moment, but to start to reverse and keep temperatures down. Just to put it in context, you will have heard a number of the stories that come with a 1.5 or 2 degree rise, but we're talking 50 centimeters to a meter over the next 100 years of sea level rise, and nearly 70% of all coastal regions having sea level rise, eroding coastal regions around the world, and possible areas of desertification, and generally a climate that is more volatile, I guess, higher, more frequent, and more vicious storms, and larger fluctuations on temperature. Just on slide 8, a bit of a difficult chart to describe here, but this is actually from the Environment Agency of Ireland. You can see there the main points to pick out here are on the chart on the left-hand side is the blue line. That's the annual emissions target that the EU has set for Ireland. So the blue line on a downward trend towards 2030. The hashed zone is the gap between Ireland's actual emissions, the light blue, and the blue line. And you can see there the ETS buffer that you get on the orange. And essentially the emissions, the ETS is a carbon marketplace and sets a target for each country. And within that that limit from now until 2030, we've got to underperform there. You can buy and sell carbon on that market, but essentially if you're hitting over the limit, you're paying a penalty. And obviously this was the first year in 2020, 2021, where Ireland paid a penalty or was due a penalty. You can see there the current rate of rollout, specifically for Ireland. Renewables aren't going to be enough to get there, so there needs to be more across the sector, and I'll talk about that in a second. But the long story short is to try and get carbon negative and or start to reduce carbon emissions and greenhouse gas emissions. We need to do a significant amount in the next couple of years. So where does this action need to be taken? You can see here the kind of split, or where the most carbon emissions are across Ireland, and it won't be surprising to anyone on the call that the national herd and agriculture is a key focus. But if I just draw your attention to what we're going to talk about, which is the power sector down in the centre box there, it's 16% as at 2019 of Ireland's emissions, which actually is a reduction since 2009 of 24% to 16%, but there's plenty still to do. And you can see in other areas, we focus at Greencoat, and you'll see other players like us try to focus on residential in the top right, 11% there, and transport. And by that, I mean heat, electric vehicle infrastructure, and EVs themselves. Agriculture is obviously going to be a very difficult thing to decarbonize, but we have made an investment, as I mentioned, which we might have time to cover a little bit later. If there are any questions on that, happy to cover those now. Otherwise, I'll hand back to Paul and we'll get straight into the overview of the renewables market. But happy, Rob, now to open up for any questions on climate. Otherwise, over to Paul.
No questions there yet.
Just go on one slide if you don't, please, Jamie. Yeah. So what I wanted to do was to give a perspective as to where we are currently on a European side, first off, in terms of the size of the addressable market for renewable energy assets. And then I'm going to talk on the following slide a bit about where we are in Ireland and what the outlook is in terms of for the Irish market, before then moving on to talk about some of the technology changes that we see emerging. I guess the key point to make is the European market is a really well-established market and has about 475 billion of operating assets today. So that gives you a good sense as to the scale of the already established market size. What you see is that is split between onshore wind, offshore wind, solar, and bioenergy. And those are the four main sectors that we see existing from a renewable energy perspective at the moment. And so the offshore wind, which is primarily found in Germany, in Holland, and in the UK, has about 80 billion of existing assets. The onshore wind, sector, which is what we mostly have here in Ireland, and also in the Nordics, France, Germany, and also Holland, has about 180 billion of assets. And then solar, about 70 billion of assets. And then bioenergy, which includes things like waste to energy, it includes biomass plants and similar things, is worth about 145 billion. So this is a well-established market. And I guess the key thing that we have seen emerging in the last number of years is that the sector is moving to having a change of ownership, where historically the big, large utilities would have owned these assets and owned them for their life. But given the amount of investment that they need to make in terms of to continue to invest in new projects and decarbonize their own fleet, what you're seeing more and more is what we refer to as a recycling of capital. And that once the assets are operational, they become suitably and tend to be owned by pension funds and insurance companies and yieldcos as alike. And that is a trend that we expect to see more and more of over the next number of years. From a market perspective, today, most of the countries in Europe are well on track from an electricity perspective towards the sort of 30 to 40% renewable electricity. And Europe has set a target of 70% renewable electricity by 2030. So these markets are going to continue to grow substantially over the next 10 years because Europe is essentially seeing renewable electricity as a solution towards then decarbonizing both transport and heat. Just maybe, Jamie, to turn the slide, and we'll just touch a bit on Ireland. Just bring that forward to the full slide, if that's okay. So here in Ireland, we've been quite successful actually so far from the electricity side in having a policy that has delivered a substantial amount of renewable energy. And today, as at 2020, we have what we refer to as 4.2 gigawatts of onshore wind. And that represents about 40% of renewable electricity. So 40% of all electricity is now coming from renewables, and that's coming mostly from onshore wind. The way we've delivered those projects has been that the government had a very stable policy in place, which we refer to as refit. And refit is essentially a feed-in tariff that guarantees the fixed price for the renewable electricity that you produce for the first 15 years of its operation. And why that is important is that it therefore creates a very low risk, stable cash flow profile for investors to essentially put their money into, because you're basically getting a fixed amount of revenue for the electricity that you produce. What we're now seeing happening is Ireland has a policy in place towards a substantial amount of renewable electricity growth between now and 2030. So the 4.2 gigawatts that you see in 2020 is scheduled to grow to over 14 gigawatts by 2030. And that will include a mix of not just growing our onshore wind, but also adding some offshore wind. People will be well aware that there are projects up and down the East Coast that are now moving, we read about regularly, as well as having more solar projects that are currently in development and should start construction soon. We expect that these projects will be financed through a mix of additional government contracts. So the government are now providing new 15-year contracts for these projects that win such award or awarded such contracts. And then secondly, we expect to see more and more large corporates coming in and looking to secure the power directly for a period of time. And that is the mechanism under which you will then see these projects getting built in a way that they're continuing to provide stable, low risk return to investors. I think finally, from an Irish perspective, roughly speaking, we have about 8 to 9 billion of assets today that are operational. So that's about the market size. And it's likely that we'll see at least 10 to 15 billion of additional investment invested in the Irish market between now and 2030.
Paul, maybe would you be able to, sorry, there's an echo maybe coming from yourself, but would you be able to touch on the solar aspect, I think, within Ireland? I think it's probably an interesting one in terms of, you wouldn't think it'd be the most efficient way. I mean, things like wind obviously speak quite easily to us, I think, but from a solar perspective, where does that lie in terms of the underlying investments? Yeah.
Yeah, thank you. It's a really good question, Rob. Yeah, you're correct. Like when Ireland has historically had a lot of wind energy, because of the wind resource that we get off the Atlantic, you get a lot of high capacity factors. So roughly speaking, an Irish wind farm will generate 30 to 35% of the time, and therefore it's quite in terms of the volume of electricity that you produce, it means Ireland gets a lot of electricity from a wind power. Solar is obviously less prevalent, albeit it's not just to do with sunlight, but obviously the typical load factor here in Ireland is about 10 to 11%. So that means 11% of the time you will generate your full output. But what has actually happened in solar has been fascinating over the last 5 or 6 years, and or maybe even the last 10 years, and ultimately the cost of manufacturing solar panels has just plummeted, from a point that it would have cost 3 or 4 million euros for a single megawatt, maybe 12 years ago, and that cost is sort of 400,000 euros. So it's dropped by a factor of 10x in the last 10 to 12 years. And what that's meant is that the equivalent cost of electricity for production, what we refer to as the levelized cost of electricity, is quite similar between wind and solar now. So you don't need to sort of give an additional support to solar in the future. It should be able to compete quite well against onshore wind, and therefore that is the reason why you should expect to see more solar coming into the Irish electricity mix in the next 10 years. And I think the other reason for that, Rob, is that it's good to have a balance of electricity. Obviously, wind is very prominent in the winter period, spring and in autumn. But obviously having an amount of solar there during the summer months, which is when we get most of the output from a solar farm, it therefore gives you a better year-round balance to having renewable electricity.
Okay, thanks. And there was another question I think that James had answered on the actual Q&A as well. People want to pop in there.
Fantastic. Okay, I might just move on to the next slide then, please. So just obviously we've spent a lot of time talking about the renewable electricity market, but I think the reason for that is that I think that is where the really the investable assets are currently from an infrastructure perspective. We've highlighted that there's close to 500 billion euros of assets in Europe in wind and in solar and bioenergy, and therefore when we look at the areas to spend our time on and to deploy capital, that's where we currently spend a lot of our time. But this is going to change rapidly in the next 10 years, and there is new opportunities emerging. And some of those that we think of them are areas like electric vehicle infrastructure, battery storage, green hydrogen, and sort of commercial and residential heating. And maybe just to touch on a couple of those, I mean, battery storage is a good example. Here in Ireland, I mean, we'll have seen also most recently kind of the issue in Texas when obviously, the weather pattern forced a lot of the wind farms to essentially not generate for a period of time. I mean, as you start to take fossil fuel plants out of commissioning, so when you start to retire things like Money Point and some of the CCGTs, you do need a lot more standby storage around for the days when the wind isn't blowing or the sun isn't shining as much, and therefore, the grid operator here in Ireland has planned to put about 2 gigawatts, which is about maybe about 1.5 billion euros worth of capital investment into battery storage in the next 5 years to sort of provide that stability that the grid will need when we're running on renewable electricity. Again, electric vehicle infrastructure, we have a huge target here in Ireland to have a number, and across Europe to increase the penetration of EVs. A large part of the services that electric vehicles will be to provide storage and stability network services to the grid. So again, these are areas that interplay with renewable electricity. And then finally, or then on the left-hand side, to talk about green hydrogen and generation. I mean, ultimately, there are a large number of industrial processes. So the food manufacturing processes, cement processes, processes that use a lot of fossil fuel heating, that will, as well as areas around transport, so buses, shipping, etc., that will need to shift away from fossil fuels, and that will, one of the technologies that's now becoming much more prevalent is the production of green hydrogen, which is ultimately using renewable electricity to separate out the H2O, so basically taking out, separating water and hydrogen, and to then be able to use that fuel. And the reason why this is becoming more relevant is because the key cost of producing hydrogen is ultimately the cost of electricity. And as we've seen the price of renewable electricity plummet as we get more and more efficient and the plants get bigger and bigger, we expect to see the value of hydrogen start to become relevant against things like traditional fossil fuels. And that certainly is the way that the EU Green Energy Deal is essentially focusing investment. They would like to see green hydrogen becoming a much bigger technology in Europe. So there's constant change. It's not just about renewable electricity. It's going to be a much wider landscape as we move towards 2030. But the key piece, we believe, is that renewable electricity plays a key enabling role to allow that to happen. So I'm just
one or two other questions, or how are you for time? Are you okay?
Yeah, I think so. I think we'll keep going. Yeah.
There's one question there, I think, on onshore wind farms and the kind of protests you might get there, and has that had any? I think it's probably maybe connected as well, even you think, to the agriculture point as well, maybe in terms of, I suppose, there's a not in my backyard kind of focus on some of that. Yeah.
Yeah, actually, so we are, we've 23 wind farms in Ireland. I mean, we published yesterday our 2020 ESG report, and you'll see as part of that, community and how we engage around communities and the role we play as long-term owners of these assets is key. We would have given 850,000 euros back to local communities last year. So we have a role of being an absolutely best-in-class responsible operator of those farms. We have, there is a reflection that you absolutely need to manage your farms in terms of noise, in terms of environmental, in terms of anything that could be of issue to local communities, and make sure that you essentially don't interfere with anybody's life. And then you need to go over and above that as well, and give something, in terms of to be a responsible person back to that community. So I think there is always an element of community nervousness around new projects, unquestionably, but I think by and large people are very supportive of renewable electricity here in Ireland and of onshore wind, and kind of as long as it's built in the right place, and that is a really key piece, that there generally is support to see that happening. I think one of the other questions I think that came up was just around hydroelectricity. One of the challenges of hydro is just you need the right type of landscape, in terms of, you obviously, hydro works best where you either have you can typically store you can store the water and then release it when you need to essentially produce the electricity. Countries like the Nordics have a huge amount of hydropower, and actually their power market is essentially driven around the availability of hydropower from the I guess the snow peaks that they have. Whereas here in Ireland, we don't tend to have as much of that type of capacity. We have a standby hydro storage facility in Turlock Hill, but other than that, it tends to be kind of subscale, and we haven't used it as much. It's a bit more prevalent in countries like Spain and France, etc., and is an important part of energy storage. But there is a view that the cost of batteries is coming down so quickly that actually it may be more efficient to run using battery power than it is to using storage, than using hydro, I should say. So I'll keep going, and then maybe keep those questions for the end, absolutely. If I just turn to the next section in terms of talking about valuation and how people should think about the assets. One of the items that I spoke about in a previous section was this concept of a refit, renewable energy feed-in tariff. And here in Ireland, if for any new projects that are built, they typically get a 15-year fixed revenue for 100%. And in addition, those revenues tend to be inflation protected, which we see is obviously quite attractive. So therefore, with a floor of 0%, so you don't suffer where there's zero, essentially where there's negative inflation. And up until now, those contracts have been set at €80 a megawatt hour. So that price is fixed. typically your costs are quite low for running a renewable electricity plant, because ultimately you don't have to pay for a fuel, unlike say a coal plant or a gas plant. And so your costs of running it tend to be things like some operation engineering works on the projects to keep the plants running, some rates, some rent, etc. But the costs tend to be much lower because you're ultimately having a high capex payment up front. And what that results in is a very high free cash flow on a euro per megawatt hour basis. So here in Ireland, we would generate circa 60 euros a megawatt hour from a cash flow perspective. And that does mean that we have very high EBITDA margin assets. So typically the EBITDA margin is 75% on an Irish asset. When you overlay that then, and if you look at the chart on the right hand side, this is the typical profile of a 30-year asset. So your first 15 years tend to be fixed, as we mentioned, so you don't have any exposure or volatility to sort of where power prices are, and the revenues tend to grow because of that inflation link. The second 15 years then are more merchant in nature, so you are having to either sell the power onto the grid at a sort of whatever the prevalent power price is on the grid, or then more recently what we expect to happen is that you would recontract the power through to a corporate PPA at that stage. In terms of the valuation approach, our mechanism that we consider is that we apply different discount rates depending on the type of cash flows that we have. So therefore, if you have very highly contracted cash flows, we tend to apply quite a low discount rate. And then if we have more merchant cash flows or more volatility in them, we basically will apply a higher discount rate for that. And when you overlay that, what maybe to bring it back together, what you will tend to see here in Ireland is that the unlevered discount rates, post-tax nominal, are in the order of 6%. So that's the kind of discount rate that you will see for a brand new Irish wind farm. And then depending on, and I'm going to come on to it in the next slide, those returns can vary depending on how much of your cash flows are contracted. So if you were to buy a wind farm that had only 10 years of refit remaining, you would then have a higher discount rate because you've got less contracted cash flow in your mix. So then how does that maybe, what are the factors that can deliver different types of returns? And Jamie, we might just turn the slide if that's possible. So there are a number of factors that we consider when we think about the returns for renewable energy and renewable infrastructure and how those returns have changed. So the first tends to be interest rates. A lot of the people who finance assets will use debt as a large proportion of their financing structure. And therefore, as interest rates rise or fall, that tends to have an impact on the overall unlevered returns that you can essentially buy assets at. So therefore, the lower the interest rates are, typically it does impact the sort of overall unlevered returns. We have seen some what we refer to as yield compression, and by that what we mean is that we have seen investors who will come in at an earlier stage. They will take late stage development risk and construction risk, and then look to sell down, as we've seen at a lower cost of capital. And we have seen the 6% number that I've mentioned to you in terms of the, let's call it the Irish unlevered return space. You know, that if we were to ask the same question 5 years ago, 6 years ago, when this was an immature market, those same numbers were probably in the sort of 8 to 9% unlevered returns. So unlevered returns have come down during that period. We don't tend to see construction risk securing a large premium. I mean, by and large, the construction risk on these assets tends to be quite low. So we don't see a massive premium to where that has been for operating assets. Geography does matter. So, you know, we talked a little bit about the countries in which we operate and where we're investing, but definitely, you know, depending on how, I suppose, long-term gilt returns in those countries, depending on the stage of the market, depending on how the regulatory environment is for the markets in which they operate, you will see different levels of return changing. And but one of the things that I think is most interesting about the European market now is because renewable electricity is now becoming cheaper than fossil fuels in almost every country. you therefore have a very solid rationale for people to make the investment case. I think the fifth point, leverage. Different investors seek different types of returns. Like from a Greencoat capital perspective, our approach has tended to be to acquire assets on an unlevered basis, and therefore we look at things on an unlevered basis and then try to leave leverage out of the investment mix on the private side. But you can obviously always boost your returns by adding increased amounts of leverage, and we typically see the spread from levered to unlevered returns being in the sort of 1.5% to 2%. So if I talk to you about a 6% unlevered return on a wind asset, that would be the equivalent of an 8% levered return. But what you're always trading with leverage, therefore, is you're essentially giving, you're allowing the bank to, or the debt provider to take the bulk of the returns during the earlier stage of the asset. So therefore, you tend to sacrifice and have to take a much lower cash yield during the first years of the operation. And then you get a higher return by being more exposed to more merchant cash flows.
Sorry, Paul, on the leverage, what's the typical level you're talking about there?
Typically speaking, if an asset, if you were using leverage, you would be somewhere between 50 and 65% geared, depending on the profile of the assets. And then finally, I think this is something that, and this is something we're seeing more and more in Europe, which is that as the governments step back from contracting on a long-term basis, or as assets become less contracted because they've been operational for a period of time, you tend to see a different mix of cash flows. So and the more merchant your cash flows become, essentially, and the less linked they are to government gilts, the higher the return that investors will seek. So you could imagine that if you had an asset that had a 30-year government feed-in tariff, those returns could be in the order of 3 to 3.5%, depending on the country that you're in, which is still obviously 300 basis points higher than the gilt risk of that country. But obviously, the closer you then get to being uncontracted and more merchant in nature, you can see the returns for those cash flows increasing to circa 8%. So we look at all of these. We're able to see right across the opportunity set in terms of different types of opportunities in these sort of areas. But what we would say to you is that there's always a trade-off between the risks you take and the predictable income available. I was going to pass back now to Jamie. I just want to see if there are any questions that we want to go through, Jamie, or will I hand back to you and that you take through where people can have the opportunity to access these opportunities.
There's one or two there, yeah. You could touch on, yeah. Yeah.
So, what technology are we seeing coming online with regards to commercial building energy supply? Here in Ireland, what we're seeing in Ireland, we've obviously moved very much towards heat pumps as a heat solution. So the government is really trying to incentivize people to not use gas as a domestic heating supply, and also on a commercial heat supply. So therefore, we are seeing heat pumps playing a much bigger role. And what that allows to happen is that ultimately it becomes a use of renewable electricity. So B, it also provides greater flexibility, because you can obviously choose to use that heating system as and when the electricity is available. So particularly when you've less demand for electricity overnight, you will see heat pumps playing a greater role. So that's one of the biggest heating focuses that we have, and we've sort of moved a little bit away from biomass and using wood pellets. It does feel that heat pumps is where the policy is moving towards. The second point, just given our target of 70% by Res 30 and the disruptive effect on the power market, how do you take a view on the merchant tail when valuing the asset? Is it just extra points on the merchant discount rate? It's a really good question. It's a key point to understand investing in this sector. Yeah, so we firstly, when we look at the merchant power price, we heavily discount that to take account of the fact that renewables is going to decouple from wholesale power, and that ultimately the times of the day where it's very windy or very sunny, power price is going to be lower than the times when that isn't the case. So firstly, you need to discount that power curve to take account of that factor. Secondly, you need to we do it on an independent basis. We don't take a view of what that curve is, but we instead use a third-party consultant, and we keep that consultant consistent in terms of how their outlook is. And then thirdly, as you rightly point out, we also use a much higher discount rate for that curve. So therefore, we're much, I guess the bulk of the value continues to sit in the project in the front 15 years. And from our perspective, we always try to have an investment in whereby, broadly speaking, your returns have already been delivered by the time you've come into that merchant tail, i.e. you've received your money back from the income stream relating to the contracted cash flows. And then finally, the last question, Tom's question there, would it be viable for you to rent roof space from households to install solar? And that was, Tom, a business model that we saw at the start in the UK emerge, and particularly the reason for the UK was that the UK had quite an attractive tariff in 2010, 11 and 12, and therefore it allowed particularly social housing to be provided with essentially free electricity, because the owner then of the panels was essentially benefiting from quite a high feed-in tariff. But really, government policy has moved away from that, and ultimately, renewable electricity now has to compete. They all have to compete on a level playing field. So the model of renting somebody's roof makes less kind of economic sense now, and in particular, people are, I think, a bit more cautious. Would be cautious about renting out their own domestic roof, because it's unclear then, what impact that can have on their house over an asset that has to sit there for 30 years. As it sort of puts a complexity with the lease sitting on top of that.
I think apologies. I think we saw quite a big portfolio trade in the market a couple of years ago. Macquarie portfolio with 10,000 rooftops within one portfolio, but there's few and far between. It's not a substantial institutional deep market, which is what we try and push towards. In the US, you're seeing the commercial and industrial rooftop space take off, big Amazon warehouse distribution centers, acres of rooftop space, allowing developers to lease the rooftop, develop the solar panels on top, and then have a direct wire PPA, power purchase agreement, between the solar panels and Amazon, for example, over a 20-year lease. A bit of that, quite high risk. We've seen kind of returns in the 12 to 15 space, and that isn't really commensurate with what we think that a solar farm should value at, and that just talks to potentially the higher risk nature and the disaggregated nature, and it's not the institutional scale there quite yet.
Is it fair to say there is an expectation that, as maybe all houses or a lot of houses do have their own solar panels, that then they might all be hooked up into the system as well, and that any additional power might come back into the system through that way? So it's rather than an institutional thing, it's more of an individual or personal thing that'll be make everyone, I suppose, all people more efficient as we looking at 2030 or 2040, etc. as well. Yeah, and
that's a big part of government policy, to essentially allow the domestic customer to essentially have their own panels and to sell whatever excess power is back to the grid. I'll just provide, just on slide 17, I thought it was useful to just give 3 real examples of transactions we've done, I guess, in the last 2 or 3 years. First, on the left-hand side, was when we bought a portfolio of assets from Quilcha, obviously the State Forestry Board. These were assets they had co-developed with the ESB and with Scottish and Southern and Bord na Móna. But ultimately, Quilcha don't see themselves as long-term owner of these assets. They see themselves as being a developer, and providing land, and then wanting to recycle their capital into early stage work. So we stepped in and became the long-term owner of those assets. And it's a model we think we will see a lot more of in Ireland. So we expect to see Quilcha, we expect to see ESB, we expect to see FSAI and the large utilities continuing to look to essentially sell down to long-term investors like Greencoat, to basically allow them to then to continue to invest at an earlier stage. On the middle box is an offshore wind farm we did in the UK. We bought into a very large offshore wind farm that the German utility RWE had built. And basically, from our perspective, RWE are a key client of Greencoats. We've invested with them also in the US as well as in the UK. The assets were already operational. It was our 4th offshore wind deal that we'd done, so we're now becoming quite big in the offshore wind space. And it was a deal that we did using a mix of private pension funds, and Jamie will touch on that in a second, that we manage money for, as well as some listed money. So we have a listed fund, and we also have a private fund, and we would do, given the size of the deal, we essentially use a mix of both. And again, that's a space that we think will continue more and more for investment opportunities. Then more recently, in January this year, we announced our first deal in the Nordic market. It was a relatively small deal in terms of £60 million, but it was a first. And what was interesting for us about this was that it was a PPA with a semi-state utility, so Gasum. So we weren't depending on a government-backed contract here, but instead a semi-state utility was prepared to essentially contract our cash flows for the first 10 years. And what was interesting about Finland is that it provides us with, it's one of the cheapest places to produce renewable electricity in Europe, because the large availability of land that they have and the ability to use very large turbines. So for us, it was a very attractive place to become an market entry into that market. And again, it's a market we think we can do more of in the future. So Jamie, I think I'll pass back to you. Maybe.
Paul, could I just ask you one? Maybe it might come up in the next section naturally, but you just mentioned listed and unlisted there, and I know listed infrastructure had a pretty tough time of it last year, obviously, which, in a normal market sell-off, which last year wasn't, you wouldn't have really expected that. But how did the listed, I suppose, renewable space hold up, versus even a global equity, let's say, just as a benchmark, let's say?
Yeah, no, we didn't. We were pretty much unimpacted by the crisis whatsoever. Our share price ended up 6.5% up to the year. I think there was probably a 7 or 8 day, I guess, kind of impact where there was a liquidity point on the share price where, we were trading, and the sector probably traded down 10-15%, I would have said, and then quickly picked back up to where we had been. So there was almost no impact whatsoever on the sector. And in fact, once it became clear, I think the sector probably pushed on a little bit again, because people recognize these are real assets, that were essentially unimpacted by global demand, and that were instead much more linked towards government policy and regulation.
Okay, thanks.
Cool, thanks, Paul. I guess just before last couple of slides, are any questions on valuation, market? I'm scared of asking a bunch of actuaries about valuation and liabilities, but if there are any questions, good time to ask now. Okay.
It's probably, is there one, I don't know, is it worth addressing maybe that there's obviously a bit of a story out there, some people, that the multiples have increased quite a lot in the renewable energy space maybe recently. Obviously that feeds into valuations, etc. as well. So obviously there's support there for that, but how does that sit, I suppose, at the moment in terms of where valuations lie, I suppose?
Yeah, I think the valuations have been, valuations are reflective of the fact, I think, for sure, as interest rates have come down and as the sector has matured, definitely returns have come down from where they were. I think I said to you, Rob, at the start, if we went back 4 or 5 years ago, the return for assets was probably in the 8%, unlevered range when we had much higher interest costs. And today, here in Ireland, you're roughly speaking at the 6%, unlevered level. And I think as you kind of see those assets contracting more, and in the very low cost European countries, so if I was to pick Germany or France, that number would be slightly below that. It would be probably in the 5.5% range. So those are the type of unlevered returns that we're seeing, and it tends to sort of benchmark back to a sort of 7.5% levered return. So levered returns tend to sort of set the market, and then unlevered returns kind of are an outcome of that. But that's the level that we're seeing, and that's playing its way through in terms of where we're deploying capital, and also kind of where our share price is on the listed side is also sort of currently being traded at.
I think, Rob, just to add, as you look at our kind of benchmark, in some ways, we are trying to deliver a cash over government bonds. So if you look at gilts or Euro benchmark for government bonds, you've seen actually a lockstep of yield compression in renewable space, but alongside that, negative yields falling as well, or more negative. So actually, when you look over the last 3 years, that spread has actually been maintained rather.
Okay,
Just sorry, Rob. So on slide 19, really, there's obviously a substantial climate need. There's a substantial market out there, and really, slide 19 shows you where the investment has traditionally come from. As Paul has mentioned, you had big utilities, and the top left-hand chart shows RWE, EDF, and SSE, Scottish and Southern's equity performance over the last few years, and you can see that they have been on a downward trend, and balance sheets are not at the capacity to be able to build out and roll out the kind of renewable energy generation, electric vehicles and/or heat generation that we need over coming years to keep us below that 2 degrees. On the top right-hand chart, some of you may or may not recognise this. This is from the Central Bank of Ireland, and shows over the last year the assets versus liabilities of the Irish pension market, and a bit of fluctuation there, but generally liabilities outstripping assets, as has become the trend over the last few years, not just in Ireland, but other liability sensitive or inflation sensitive investors. And as I just mentioned, yields, we're struggling to get hold of yields, especially with the negative yield environment across Europe, and more so in the UK, although we have seen an uptick, which doesn't help my chart in the last couple of months. And just on the right-hand side, I guess, if we go down the traditional model of a 60-40 equity debt split within a more traditional pension fund, we're going to have to see outsized returns in the equity markets. And I think more and more we're seeing that pension schemes need to de-risk away from equity markets. But if they were to maintain that, we need to see 9 or 10% returns on an annual basis to be able to close the funding gap. And really, traditionally in the UK and US specifically here, sorry not to bring up the Irish stock market, but UK has on an annual basis delivered 3%, and over a 10-year return, US is 6%. So what does that mean for investors? When I'm speaking to investors, and when Paul speaks to investors, we see most of my space in the pension and insurer world on a de-risking journey and trying to look for an alternative source of income. And really, there are a number of different things that you can do in that space: private credit, real estate debt, infrastructure debt. And we feel that renewable infrastructure fits well into the space in equity space, in renewable infrastructure equity. As you can see here on slide 20, there's a number of parties. There's slightly bigger cousins at BlackRock, who are pretty substantial now, I think 8 trillion under management, actually similar size on the renewable side of things. You have the listed sides of the businesses. So Paul runs our piece, and then you have the likes of Bluefield, Foresight, Impacts, who have all listed vehicles accessible through either investment trusts or infrastructure funds on the stock market. And you have the likes of Dalmore, who are, and Infrared, who have a generalist infrastructure approach. Equitix could be one of those, and they kind of go into social and into renewable infrastructure. And then you have specialists such as ourselves, Greencoat, Next Energy, who are either very specific in the case of Next, where they only look at solar, or a little bit broader on Greencoat. There is a massive need for institutional investment in this market, and we think at the moment, in the search for yield, the infrastructure equity space, and specifically renewables, delivers a low risk but yield above government bonds, which can help the pension schemes and insurers of these well.
A few questions there, Jamie, maybe that we could touch on. A good one on COVID, actually, just how that's affected the ability to perform due diligence and source deals like over the last 12 months.
Actually, very little impact. I mean, we had one of our busiest last 12 months across the business, and the practical sides of COVID have played themselves out where, where we've had to do site visits. We've done it, kind of on a sort of a very small team basis, or one or two people. An example of our deal in Finland, we sent our local partner up there with the drone. We did live feed of kind of what full viewing of the site, doing that. But actually, I think what you've seen from COVID actually is a flight to quality in terms of people who they know they can execute, that are funded, less sort of, and a much more execution focus from developers and utilities in terms of who they want to partner with. So, we'd be pretty positive, and I would say some of our other competitors would be equally minded to give that kind of outlook as well.
Okay, there's another one there, which is interesting in terms of the limit to the amount of generation that can be done outside of a country, or I suppose probably transported outside of a country, and a possible move towards a global, but I suppose maybe a broader electricity market is probably, that's an interesting.
It's absolutely really good point. I mean, we are becoming a much more integrated electricity market. Here in Ireland, we're building integration between Ireland and France, between Ireland and the UK. The Nordics that I touched upon is interconnecting out between, Germany, Holland, and into countries like that. Denmark, which is clearly a leader in renewable electricity, is now moving into, into exporting power down into the mainland, into Holland and Germany. And clearly, the big question mark about what happens next is how do we essentially start to see a lot of hydrogen power being produced where the renewable electricity is cheapest. So probably countries such as southern Spain, Morocco, maybe even Saudi Arabia, and how do those countries that have a cost advantage in terms of renewable electricity, how do you then get that hydrogen into Europe? So I think at the moment the electricity markets, I think, are more coupled on a sort of European-wide basis, but that I think you will see hydrogen potentially as a fuel be sold much more on a global basis.
Okay, and no doubt Texas will be revisiting their own decision to stay outside of the US as
exactly.
grid.
They created their own issues, exactly.
Yeah.
Benefits of benefit. And I think finally, it's a really good question in terms of yields come down. Do we see long-term investors becoming more involved? I think it depends what your strategy is. What we would say is, if I go back to the slide when we had 475 billion of addressable market in Europe, what the market really needs is stable long-term capital. The utilities and the developers are pretty well funded, but what they're really looking for is the ability to recycle their capital out once these assets are operational. So the wave of funding that we certainly see happening is much more in sort of low risk, and lower return, as opposed to where historically potentially in pension funds have played, in my view, is much more in the private equity space. So seeking to take, late stage development risk, seeking to take, kind of construction risk, and ultimately trading off stable income, for ultimately trying to get more returns into private equity. So, that 12 to 15%, returns that people had, or what are now 10% returns, that has been a bucket of where we've seen private pension fund money in the past. But we certainly see that transition into now being more around having stable, predictable cash flows, that are highly regulated.
I think it's a super question, and I think it's not just about, Paul's kind of framed it so well. It's what's the strategy of the scheme, the insurer, whatever it is. Are they trying to match cash flows, or are they looking for growth? And I guess just taking you back to slide 16 there, in what I would deem traditional construction risk, i.e. post-planning, all documentation in space, shovel ready, as Paul mentioned, you've got about 25 bits of construction risk premium there. It's very, very little. These are very modular, short-term construction timelines, except in energy from waste, maybe where it's 3 years. But for a typical wind farm, Paul, I don't know how long the Finnish wind is, 12 months, 18 months?
Yeah, 12 months.
In solar, you're going to see Irish solar roll out in less than 6 months. It is so kind of well understood. So therefore, if you're on the growth strategy in renewables, you're heading off to Chile with the likes of Mainstream and BlackRock's new funds, and you see them moving out of the traditional markets and into, dare I say it, riskier markets, try and bump up the return to get to what we were looking for a wee while ago of the 10s and 12%, plus leverage, plus a bit more merchant.
Okay, I think that brings us. There's no more questions, and I think we're bang on just after 1:30. So probably leave it there. So just thanks to Paul and Jamie. I think that was very informative and great to have a good few questions. I think it's always a good sign that people are engaged and interested. So yeah, just reiterate our thanks to you guys for the prep and the presentation. And yeah, thanks to everyone for dialing in. I hope you get some well needed lunch.
Thank you very much.
Thanks everyone. Bye bye.